Hi guys and gals, I hope you're doing well today. Today's video, I thought we would talk about how to use 13F season to copy the great investors that are out there. In one of my previous videos, I talked about cloning the ways people and companies do it, and how it can be done in life, and how that can relate to investing. One of the easiest and most popular ways to do this is for US companies. Unfortunately, it's much harder to track super investors' investments outside the US, but it's not impossible, and I'll go more into that later on in the video. So Congress created the 13F requirement in 1975. Its intention was to provide the US public a view of the holdings of the nation's largest institutional investors. Lawmakers believed that this would increase investor confidence in the integrity of the nation's financial markets. Institutional investment managers that have more than $100 million of AUM, assets under management, have to file a quarterly 13F form with the SEC. This form, it details their holdings and what they have bought or sold in the last calendar quarter. But it doesn't have to disclose cash holdings or short positions, so watch out for that. The 13F filing, it has to be filed within 45 days of the end of the last calendar quarter. And a lot of investors wait as long as possible before they have to disclose what they've been buying and selling, in case it drives the stock price up or down, if they're still building or reducing a position. And when we see what an investor has bought or sold in a 13F, we can be sure that they did this within the last quarter. The exact date or price at which the transaction or transactions were executed is not disclosed. But this is just an opportunity, or at least I see it as an opportunity, to build in an extra level of margin of safety for us. I don't know exactly what price they bought in, so I'm just going to be conservative and assume they bought at the lowest price, which obviously it would have been extremely difficult for them to have done that. When cloning, you don't want to blindly clone. Imagine you see a super investor that has bought a stock as part of the 13F form, and as soon as you see that, you just buy the stock as well. You just want to clone. You've heard that cloning's a good idea, so you just buy the stock. Well, what if the price has gone up since then? They could have bought at the start of the last quarter, so they could have had 3 months plus 45 days if they submitted it 45 days after the quarter. That's a lot of time to pass. How do you know that you're getting a good price? It could have gone way out of the margin of safety price, and you wouldn't even know. A good company, and this is very important to remember this, a good company, a wonderful company, can be an absolute terrible investment if it's bought at the wrong price. Cloning should not be done blindly. If it's done blindly, it should be done with some rules. So how can we do it? Well, we can use companies that investors, super investors, we can use the companies that they have bought as a kind of to-do list of potential investments to look at and do our own due diligence and our own research into. You can make a list each quarter and apply some quick filters to whittle it down. Monish Pabrai says you want to say no as quickly as possible. Read as much as you can and get to a no answer as quickly as you can. Most days, he gets stock ideas put on his desk by his assistant at 11 o'clock a.m. and by 11:15 he's done. He knows his circle of competence, and he has a few filters or screens that if a company doesn't pass those first hurdles, then it's not worth looking into anymore, and just say no. Goes in the too hard pile. It goes in the no basket. You could start with a universe of 10,000 stocks, but wouldn't it be great to have some of the best minds of some of the best investors that you admire do that for you, and then tell you every quarter what they're doing? Matthew Peterson of Peterson Capital Management, he starts out with this. The 13F goes in the top of his funnel, and he starts his own process of whittling them down. And once you've done your due diligence and research, you kind of have two buy prices. You will have done your own valuation as part of your research, and you'll have your own margin of safety buy price based on that. You will also be able to take a conservative guess at what price your super investor paid as well. If you assume that they were amazingly brilliant at market timing and bought at the low of the last quarter, which you can be sure they didn't, but anyway, then this adds in a level of conservatism and a margin of safety to the investment. Warren Buffett is actually quoted as saying once before, make sure you are buying a business for way less than you think it is conservatively worth. I actually printed this off and I underlined the word conservatively, because the more conservatism you can build into your valuation of the business, the more you can protect yourself from errors of judgment and increase your rate of return overall. Of course, there is such a thing as being too conservative, where you'll never actually, get a chance to buy the company, as your buy price is just way too low because you're being way too conservative. But markets can do amazing things. You think a company's share price can't drop 50%, and then like a black swan event comes out of nowhere, and suddenly you're down 75%. So if you assume that they bought at the low of the last quarter, and you have your own self-derived buy price from your own research, then you have 2 points of reference. There are other valuation methods that you can apply. You don't have to just apply one valuation method. So you can have more points of reference, more buy prices, which would kind of give you a range at which intrinsic value likely sits. But at least with this method, you'll end up with 2 points of reference, two prices. So now some resources for you. Where can you get this list of companies that super investors have bought or sold? So there are a few free tools online to access this information, and I'll link them down in the description below. But the one I personally use is Dataroma. But I know others have dived into whale wisdom as well. There is also a great tool called Ticker Terminal, which will show you super investors' positions outside the US listed companies, and also provide all sorts of financial information and stats on international companies. However, a free plan is limited to US holdings only, and it's limited by the number of super investors that you can actually keep track of and look at. But if anyone was looking for a great service to provide this at a subscription, you can't really go wrong with Ticker. Okay, so that's all I wanted to cover for this one. Hopefully now you've got a better grasp of how we can use the best investors and what they're buying and selling to enhance our own process and our portfolio. Almost all of my investments are clones, and I can certainly recommend it as long as it's done right with your own research. Let me know what you guys think about cloning in the comment section below. Without much further ado, I will let you get back to your day. So let's get out there and become super investors together. Until next time, take care.